Okay, ladies and gentlemen, colleagues and distinguished guests, welcome to the 2014 Sir Celestine Melville Public Lecture. My name is Martin Richardson. I'm from the Research School of Economics here at the ANU, and before we do anything, I'd like to ask you to check that your mobile phones are muted or off or in some sort of dormant state for the next hour and a half, please. I'd like first to acknowledge the traditional owners of the lands on which we meet and pay our respects to the elders of the Ngunnawal people, past and present. I'm the convener of the various public lecture series managed by the Research School of Economics here at the ANU. And my role in these proceedings is basically to hand over very quickly to Professor Selwyn Cornish, who's going to say a few words about Sir Celestine Melville, about the lecture series, and to introduce our distinguished speaker tonight. That speaker, Professor Forrest Capie, has indicated he would welcome a questions and answers session at the end. Well, actually, to be honest, he said he would welcome questions, he can't guarantee answers. But he's kindly agreed to sort of finish up with about leaving 15 to 20 minutes, hopefully at the end, for some discussions. I can tell you now we're almost certainly not going to have time for every question. I apologise in advance to those of you who don't get your time. But we will have a reception held at the back at 7 o'clock until 7:30. So hopefully any unanswered questions you can harass Professor Capie over a drink. To introduce our speaker tonight, I'd like to hand over to Professor Selwyn Cornish. Selwyn will be known to many of you, of course. He's one of Australia's most distinguished economic historians. He's a member of the Order of Australia, a prize-winning author. He's currently the Reserve Bank of Australia's official historian. He's a former Dean of Students here at the ANU as well as University of Marshall. And he played a very significant part, in fact it understates it, he played an absolutely critical part in getting this lecture series set up in the first place over 10 years ago to honour Sir Celestine Melville. There's really no one better placed to discuss Sir Celestine Melville and to introduce Professor Capie, and I'm very happy to hand over to Selwyn. Selwyn, please.
Well, tonight's Melville lecture is the 13th Melville lecture. The first Melville lecture was given in March 2002 in this hall by Ian Macfarlane, who was then the Governor of the Reserve Bank of Australia. And the occasion was to celebrate the 100th birthday of the ANU's second Vice-Chancellor. Sir Leslie was in the audience that day, just sitting down there, but he died suddenly a few weeks after the lecture. And the university then decided to hold an annual memorial lecture in his name. Celestine Melville was one of Australia's most distinguished economists. He was a graduate of the University of Sydney, where he took first-class honours in economics, and at the same time he was studying externally through London for qualifications to become an actuary. And at the age of 21, he was appointed South Australian Government Actuary. And since he was the only person with an economics degree in the senior ranks of the South Australian Public Service, and probably in any Australian public service, and certainly there was no one in the senior ranks of the Commonwealth Service with an economics degree at that time, Melville quickly became economic advisor to the South Australian Government. And if you're thinking that he was a boy wonder, that's exactly how the newspapers described him in the 1920s. Smith's Weekly in particular made much of the boy wonder in photos and sketches. In 1929, at the age of 27, he was appointed to the first chair of economics at the University of Adelaide. But his career really took off when in 1931 he became the Commonwealth Bank's first economist. And there he created the Economists Department, which was the forerunner of the Reserve Bank of Australia's Research Department, now the Economic Group. He helped the Commonwealth Bank to become Australia's central bank. Indeed, Ian Macfarlane, in his Melville lecture, said, and I quote, "If you read through the correspondence files in the archives of the Reserve Bank in the 30s and 40s, you could be forgiven for thinking that Melville was the central bank." He was a member of the Copeland Committee, which in 1931 drafted the Premier's Plan, which Keynes said, quote, "saved Australia." He attended the Ottawa Conference in 1932 and the World Economic Conference in London in 1933. And during the war, he was a foundation member of the famous F&E Committee, the Finance and Economic Committee, which advised the federal government on war finance and post-war reconstruction. In 1944, he led Australia's delegation to the Bretton Woods Conference. The other three members of the delegation were Fred Wheeler, Arthur Tang, and Jim Brigden, a fantastic quartet that represented Australia at Bretton Woods. In 1945, he observed the first annual meetings of the IMF and the World Bank at Savannah, Georgia, as the Australian government's representative. And from 1947 to 1950, he was a member of the UN Subcommittee on Employment and Stability, taking over as chairman of that committee on the resignation of Ragnar Frisch, the co-winner of the first Nobel Prize in Economics. From 1950 to 1953, Melville was Australia's executive director at both the IMF and the World Bank, and from 1953 to 1960, he was the ANU's Vice-Chancellor, overseeing the amalgamation between the original ANU and Canberra University College. When he retired from the Vice-Chancellor's position in 1960, he took on a range of jobs, including chairman of the Tariff Board, from which he resigned over the protectionist policies of John McEwen. Thereafter, he chaired the Grants Commission for 8 years, led World Bank missions to the Philippines and to Syria, and chaired several government committees of inquiry ranging from wages and industry in PNG, a new superannuation scheme for Australian government employees, and proposals for a health insurance scheme funded in part by the government. And I should add that from the early 1950s to the mid-1970s, Melville was a member of the board, first of the Commonwealth Bank, and from 1959 of the Reserve Bank, a period in total of 25 years. No one before or since has exceeded that record. Again, as McFarlane has pointed out, Melville was either an employee or a board member of Australia's central bank for more than 45 years. Now, because of Melville's close association with the development of central banking in this country, there's been a strong connection with central banking among those who have given the Melville Lecture. 3 of the lecturers were governors of the central banks. Ian Macfarlane and Glenn Stevens were governors of the Reserve Bank of Australia when they gave the Melville Lecture. Stevens, of course, still the Governor of the Reserve Bank of Australia. And Alan Bollard was Governor of the Reserve Bank of New Zealand when he gave the lecture in 2012. Charles Bean, the Deputy Governor of the Bank of England, gave the lecture in 2011, and 4 other Melville lecturers were or are members of the board of the Reserve Bank, Professors Gregory and McKibben, and Treasury Secretaries Ken Henry and Martin Parkinson. Well, this close association between the Melville Lecture Series and central banking continues this year. Our speaker tonight is Professor Forrest Capie, Professor Emeritus at the Cass Business School in the City University of London, a distinguished historian of central banking and a former Bank of England official historian. Forrest was educated in New Zealand and London. He has a BA from the University of Auckland and an MSc and a PhD from the London School of Economics. He lectured at Warwick and Leeds universities before moving to the City University of London, where he became Professor of Economic History in 1986 and Professor Emeritus in 2009. He's published extensively in the related fields of banking and central banking and trade and commercial policy. He edited the Economic History Review, one of the world's leading journals in economic history, from 1993 to 1999. Between 1999 and 2005, he was a member of the Shadow Chancellor's Advisory Panel, and more recently he's been a member of the Academic Advisory Council of the Institute of Economic Affairs and a member of the Council of the Taxpayers Alliance. He has served as advisor to the UK Parliamentary Commission on Banking following the global financial crisis. From 2004 to 2010, he was the official historian of the Bank of England, where he wrote the fourth volume of the bank's history, which covers the period from the 1950s to the late 1970s. The title of his lecture this evening is The Limits of Central Banking, Central Banks and Financial Crises. And it's my great pleasure now to invite Forrest Capie to deliver the 13th Sir Leslie Melville Memorial Lecture.
It's a great honour to be invited to give this lecture. You've just heard how distinguished a figure Sir Leslie Melville was in Australian public life, and particularly in its monetary and financial life. He was, as you've heard, a professor of economics at the age of 27. That's even younger than Mervyn King, the recently retired governor of the Bank of England, who was appointed a professor of economics at the age of 29 at the University of Birmingham. But just 2 years after that, Leslie Melville was appointed economic advisor at the Commonwealth Bank, as Selman has told us. I think that was extremely enlightened action on the part of the bank. It was more than 30 years later before the Bank of England consciously appointed an economist, and that was under pressure from the Radcliffe Committee, and then he wasn't allowed to do anything anyway. It'd be another 10 years after that before they appointed an economist as an economic advisor. So Leslie Melville was clearly an outstanding figure, and he was at the heart of Australia's economic policy making from the 1930s onwards, and for the post-war years, I have seen him described as Australia's leading monetary economist. So it's very humbling to be giving a lecture in his honour. I'm going to be talking about central banking, as the title suggests, central banks particularly in history. And I need to say something about what these central banks were, particularly in their early years. It's not easy to identify them as central banks. It's often asserted that the Swedish Riksbank, founded in 1668, was the world's first central bank. But by almost any definition, there was no such thing as central banking at that time. There was hardly any modern fractional reserve banking anywhere. Clearly, central banks can be defined in a number of ways, but in order for the definition to be useful, it needs reasonable precision, while at the same time allowing for slightly differing conceptions. Central banks at the beginning of the 21st century had a relatively clear and agreed focus. They had two core purposes: the provision of monetary and financial stability. Some central banks still had mandates that required them to deliver, or at least keep in view, full employment and economic growth. But that aside, what had come to dominate was monetary or price stability. And in the pursuit of that, many central banks had adopted inflation targeting. In the long period of steady growth that most OECD countries enjoyed in the last 20 years of the 20th and the first years of the 21st century, financial stability had drifted almost out of sight. It was taken for granted. The two core purposes then of central banking are intimately related. Monetary policy doesn't exist in a vacuum. It depends crucially on the exchange rate regime and is also closely linked to fiscal policy. A country with a floating exchange rate can have an independent monetary policy, and government can therefore have, via the central bank, control of the money supply. If a country operates within a fixed exchange rate regime, it cannot have an independent monetary policy. It then lacks this control and must accept the monetary policy of the dominant country in the particular fixed exchange rate system. When there is an independent monetary policy, how the central bank executes its power will vary depending on factors that range over institutional arrangements, prevailing economic beliefs, political preferences, and so on. It might aim to control money supply directly, as the Swiss central bank has on occasions done, or it might operate on prices, that is to say interest rates, as the majority of central banks have done. Or as has been the case more recently, the central bank might approach matters differently to achieve a price or an inflation target. When the principal objective of the bank is price stability, the operating procedure has usually been through short-term interest rates. How good an indicator of policy stance these are remains debatable. But by acting through short-term interest rates, the central bank controls the growth of the monetary base and hence influences broad money, and that has an impact on the economy. The influence over interest rates also means the bank has some part to play in the determination of the exchange rate, the nominal exchange rate, since there is a relationship, albeit a complex one, between interest rates and exchange rates. When there are exchange controls in place, as there were for much of the 20th century, the central bank is often made responsible for administering such controls. The institutions that are central banks today often had similar origins. The first were usually established as government banks, carrying out the business of government. That commonly involved lending to governments, often on favourable terms. Initially, they may not have had the sole right to issue notes, but that is something they generally acquired over time. However, if the principal defining characteristic of a central bank is, as some would argue, its acceptance of its role as stabilizer of the financial system, then their proper founding dates come much later. Now, in this lecture, I wanted to focus on that second core purpose, that of providing financial stability. I do that by looking at financial instability, and I begin by looking at the first great financial crisis of capitalism, that of 1825. I then turn to what was the worst financial crisis of its time, that in the United States in the 1930s. And I conclude briefly with the most recent, and by some measures, the worst financial crisis of all. I make no apology for the history, rather the reverse. If a better understanding of and respect for history had been held, the likelihood of crisis would have been lessened or conceivably avoided altogether. So, to financial stability. The term has proved hard to define, but one way of thinking about it is to define stability as the absence of financial crises. That, of course, requires a definition of financial crisis. And I choose one that has become a classic in the literature, that of Anna Schwartz. Anna Schwartz wrote, "A financial crisis is fueled by fear that means of payment will be unobtainable at any price, and in a fractional reserve banking system leads to a scramble for high-powered money, for cash. In a futile attempt," she continued, "to restore reserves, the banks may call in loans, refuse to roll over existing loans, or resort to selling assets." That definition, for me, contains the key. A fractional reserve banking system is necessary before a crisis can develop. That was not in place before the beginning of the 19th century. Fractional reserve banking, modern fractional reserve banking, did make an appearance in the 17th century, and that was the basis of the British system, but it was not sufficiently developed. There wasn't a sufficiently large banking multiplier, if you like, to mean that when one bank failed, the depositors generally failed on a large scale. There were externalities that spread around the system. The banks, through most of the 18th century, were really much closer to cloakrooms. You put your deposit in, you went back and got it out when you chose to, and the banks didn't lend these deposits on to any great extent. So it's really the beginning of the 19th century before we've got a sufficiently developed fractional reserve banking system in which a crisis is likely to appear. And indeed, they did appear on a grand scale with, as I said, the first great financial crisis of capitalism that occurred in 1825. And in many ways, it was a template for the typical crisis that followed, of which there were many. Considerable monetary ease, monetary expansion, was followed by booming conditions. There was a stock market boom, general euphoria, some displacement, as Kindleberger calls it, and a peak and a collapse. The background to the 1825 crisis was of industrialization and the development of the banking system throughout the course of the 18th century. In the Revolutionary and Napoleonic Wars between 1793 and 1815, the gold standard was suspended in England, and the Bank of England could issue notes without limit. And it appeared to profit greatly from doing that. There was inflation across the period and depreciation of sterling. After the end of the war, deflation followed, partly in an attempt to allow the restoration of the gold standard as soon as the old parity could be achieved. A period of recession followed before the gold standard was eventually restored in 1821. At that time, the Bank of England was at the centre of the system, the banking system, made up of hundreds of banks, partnerships of limited size with unlimited liability. Many had failed in the deep post-war recession of 1815-17. There was also the beginning of discount houses, discount brokers initially, who would later become the discount houses, and they provided an early interbank market. But with monetary stability restored after 1821, or at least re-established in 1821, vigorous economic growth resumed. The investment boom followed, especially in infrastructure. At the time, gas lighting, canals, railways. The developing boom was reflected across all of domestic output, with rapid increases in manufacturing, cotton, wool, hardware, etc. In 1825, 624 new joint stock companies were formed, and an export boom was close behind. The stock market boom came partly from foreign, particularly Latin American stocks. As former Spanish colonies gained independence and believed prosperity was theirs, they borrowed heavily. The distinguished and ultra-cautious Bank of England official, George Wade Norman, invested heavily in these new stocks. Everything seemed set fair, a new paradigm, perhaps. Easy money and abundant credit. Between 1819 and 1824, there was a large gold inflow, and the Bank of England was flush with reserves. The bank rate, which had been constant at 5% for the previous 50 years, was reduced in June 1822. the Bank of England accommodated all the government's fiscal requirements. Moreover, there was considerable conversion of debt to lower yields. In 1823, there was a conversion of £135 million of a 5% stock to a 4% stock. Now, just to get that into some kind of context, GDP at the time is about £300 million. This is a conversion of one stock of 135 million to a lower interest rate. In 1824, another 80 million was converted, 4 to 3.5%. And as I indicate, this was all done when there was a colossal debt to income ratio, roughly 250%. Well, and here you'll see, I'm sure, similarities with recent times. The recipients of the lower dividends sought higher returns elsewhere, and there were plenty of schemes on offer. Country banks, these small banks scattered around the provinces of England, they joined in and issued their notes more freely. Parliament in 1822 allowed them that freedom for another 10 years. In 1824, these banks stamped twice as many notes as they had in 1820. The following year, notes were up by another 30%. So you can get some sort of a feel for the monetary ease and the monetary expansion and the spending and investment and general feeling that we had entered a new era and we had finished with the constraints of the past. And then the crisis broke, really without any identifiable trigger. At the beginning of 1825, the Bank of England had begun to worry about the extent of the expansion, and in March of 1825, it sold exchequer bills as a means of contracting circulation. And it continued to be cautious thereafter. The stock market crashed in April 1825, and that triggered commercial failures. Commodity prices began falling, and bank failures began to appear in the summer of 1825. The banking panic came in December of that year. On the 8th of December, the Bank of England gave quite considerable assistance to a bank called Paul Thornton and Company. And yet 10 days later, that bank failed. It was an important bank, a London bank, but it was agent for 47 country banks. The great banker, monetary economist, parliamentarian, and other things, Henry Thornton, had a son who worked for Paul Thornton, and of course Thornton himself had been an original partner. On the 13th of December, the banking system was poised on the edge of an abyss. Bank rate was raised to its allowed maximum of 5%. In the following week, 4 big London banks failed, together with 60 country banks. But by 16th of December, it was all quiet. And the first of the great cyclical crises of capitalism was over. All the bank failures that there were also over by the end of the following month. The Bank of England's response to this crisis had been in part constrained by regulation, particularly the usury laws. But it was slow to act, and then it reversed its policy, and it began to lend. And eventually, as Jeremiah Harman, director of the bank, put it, we lent by every possible means and in modes we had never adopted before. We took in stock on security, we purchased exchequer bills, we not only discounted outright, but we made advances on the deposit of bills of exchange to an immense amount. In short, by every possible means consistent with the safety of the bank. He continues, seeing the dreadful state in which the public were, we rendered every assistance in our power. Nevertheless, the criticism of the bank being slow to act remains. There were many failures in the banking world, and there was the serious recession of 1826. Unemployment soared, and there was rioting, widespread rioting. The bank was the main culprit. Its expansionary monetary policy had fueled the boom, and its tight monetary policy had brought it to an end. Furthermore, it didn't know how to act as a lender of last resort, or did not accept the role. The remedy was there. The remedy was well known. It had been laid out by Henry Thornton in 1802, and it was again by a man called Thomas Joplin in the middle of the crisis in 1825. On the evening of the 13th of December, when the bank was showing reluctance to lend, Thomas Joplin published a letter in the newspaper The Courier. His case was, briefly, that the bank had precipitated a liquidity shortage by its policy of monetary tightness. That resulted in completely abnormal increases in precautionary balances outside the bank. The bank should, said Joplin, increase its issue to offset the loss of circulation. Interestingly, Joplin continued this expansion of the money supply, of the money base, as it would be called later, could be done quite safely without a fear of inflation, because the increase in the money supply affected the price level and the exchanges only after a long lag. And these extra notes could be withdrawn from circulation once the crisis had passed. Thomas Joplin was from the north of England and described as a rough man from the timber trade, and the suggestions are that people in the City of London weren't very inclined to acknowledge his claims or to follow his advice. The banker, Vincent Stuckey, was a more acceptable figure. On the morning of the 14th of December, he wrote to the bank. He wrote to the governor. He had access. This is 12 hours after Joplin's piece appeared in the newspaper, and he made the same case. And he pressed the bank to reverse its policy and to lend freely. He also made the same point as Joplin had made, that emergency additions to the money supply would not affect the price level. And that very morning, the bank opened its doors and proceeded to offer financial assistance on an unprecedented scale. Incidentally, Stuckey was Walter Bagehot's uncle. And both Bagehot, first of all Bagehot's father, and later Bagehot himself, worked in the bank of Stuckey and Bagehot. Though Bagehot made no reference to his uncle or the policy in his famous work, Lombard Street. It may seem unfair to put all the blame on the Bank of England for this particular disaster. It was still a private company, and it was restricted by regulation that prevented it from behaving as it might. Nevertheless, it must accept most of the blame. After 1825, after this disastrous experience, it did begin to learn, albeit slowly, how to behave. There were several crises in the 1830s, 1847, 1857, 1866, in all of which the bank could be held to have been responsible to some extent, both for the easy money conditions that led to the crisis and for the tightening at the wrong time that led to the contraction. But over that period, in these 40 years, it learned how it should behave, partly came from promptings from commentators such as Bagehot, and it arrived slowly at a position where it accepted that it was the centre of the monetary system, the monopoly note issuer, that its responsibility was primarily a public responsibility and a secondary one was to its shareholders. And it accepted, in effect, its role as the lender of last resort. And therefore, it's for that reason that I date the beginning of central banking and the Bank of England being at that beginning in the late 1860s, 1870s. Of course, the other parties had to learn their respective roles. The commercial banks had to find their way to appropriately structured balance sheets, sufficient capital and liquidity consistent with acceptable profitability and so on. It was necessary, too, to have an appropriate regulatory environment. Joint stock banking was allowed, first of all. The usury laws were gradually removed. Limited liability was permitted. The gold standard was more precisely, clearly defined. And an understanding was reached on how the gold standard could be relaxed in a time of crisis. And when all these elements were in place, roughly from the 1860s onwards, there followed a period of 100 years of financial stability. There was occasionally a year when a famous bank would fail, such as Barings in 1890, or there would be an exchange rate crisis might blow up, such as there was in 1931, but there were no financial crises in England between 1866 and 1874. Let me say something briefly about 1914, when there was undoubtedly a crisis, but it was not a typical financial crisis. There's no preceding boom, there's no monetary ease, there's no state of euphoria. Out of the blue, war breaks out. And on the outbreak of war, there was a complete failure of remittance from abroad when London is the hub of an extensive international financial system. There then followed all the typical features of a financial crisis, and to some extent, the response needed was what was needed in a typical crisis. It was not a pure liquidity crisis, so other measures were required, but there was a liquidity crisis, and so the lender of last resort was also required. The measures taken at that time, 1914, are generally held to have been brilliant in their design and execution. Unfortunately, but as has frequently been the case, there are no archival papers on which to judge the Bank of England's contribution to the resolution of that crisis. The bank's historian for the period, Richard Sayers, concludes that there was no sign that the governor, a man called Cunliffe, quote, brought into this task an inventive mind, nor was he a man to formulate an elaborate policy. The credit, actually, for the resolution of that particular set of events goes to the Treasury. Well, let me remind you next of the Great Depression in the United States in the interwar years. Certainly the biggest financial crisis that the world had seen to that point. It was against a generally fragile international economic background in the 1920s that the Great Depression of 1929 to 32 took place, though the Depression was far from inevitable. In the Depression's aftermath, many explanations for its origins were proffered. One was that it was the unfortunate coincidence of the timing of all the different economic cycles. Another that gained acceptance quickly was that there was an autonomous fall in investment. Yet another was that the gold standard had outlived its usefulness, or that the new version, the post-World War I version, inspired no confidence. But after the work of Friedman and Schwartz, there was growing acceptance that the Depression was a consequence of the failure of monetary policy. A normal cyclical peak was reached in the middle of 1929, and a downturn followed. The downturn was made worse by a stock market collapse towards the end of the year. But the real failure came when the Federal Reserve, reading the wrong signals or misreading the right signals, did nothing to prevent or alleviate the banking failures that came in 1930 and 31. The monetary base was not supported and the money supply collapsed. In spite of the lessons of the 19th century and the clear position that the Bank of England had reached, and the fact that the Fed had on occasions used open market operations, it failed to do so at the critical point in 1930-31. Of all the major economies, the US had the worst experience. The American economy, of course, had long been volatile, and in the 19th century always considerably more volatile than the British economy, and that continued after the First World War. But the scale of the Depression in the United States at the beginning of the 1930s had never been seen before. Data series are always being revised and in many cases remain contentious. But while there might be some debate over precise figures, there is none about the general scale. The scale of the collapse, as captured in GDP, is truly staggering. Money income fell by 15% in the first year of the Depression, by 20% in the next year, 27% in the third year, and by a further 5% in 1932-33. There were also price falls going on at the same time, and so the real income fall was slightly less. Nevertheless, the real GDP fell by 30% across the Depression. The fall in industrial production was even greater than that, as is usually the case in industrial economies. It fell from a peak to its trough by something of the order of 47%, the worst of any country in the world. These figures, viewed in the context of the 20th century, or indeed of all modern economic development, were truly terrible. The related unemployment figures tell a similar story. Unemployment in the US in the 1920s had settled at around 3 or 4%. Again, the robustness of the data is less than total, but there's no dispute about the scale. Unemployment climbed steadily to around 25% at the depth of the Depression in 1933. At that point, 13 million people were out of work. Friedman and Schwartz maintain that the Federal Reserve's failure to act as the lender of last resort in the series of financial crises spanning 1930 to 32 was crucial to the collapse of the system. So many US banks went out of business or were taken over by other banks in successive waves of bank failures that there was this major monetary contraction. Ben Bernanke, in a speech in 2002, when he was a governor of the Fed rather than its chairman, apologized to Milton Friedman, who was in the audience. He apologized on behalf of the Federal Reserve. He said, "We did it. We're very sorry, but thanks to you, we won't do it again." Well, Friedman and Schwartz had pointed particularly to the acceleration in the pace of bank failures from November 1930 onwards. The Depression, in their story, need not have happened. There had been the downturn in 29, a stock market collapse, of course, and recessionary conditions there. But when financial crisis struck, the Federal Reserve could have acted, but it felt to act. In November 1930, a firm called Caldwell and Company of Nashville failed, the largest investment bank in the South, and its failure was followed by a wave of bank failures across agricultural areas in the States. Then in December, the Bank of the United States failed. The subsequent series of liquidity crises did not end until March 1933, when President Roosevelt closed all banks and suspended gold shipments abroad. Although there were uncertainties over the policies of the new administration, particularly over its attitude to gold, these uncertainties are not a compelling candidate as a cause of the wave of bank failures. Two explanations for the bank failures, two principal ones, have been advanced. One was poor behaviour of the banks themselves in the previous years, essentially lending too freely, and second, the behaviour of the Federal Reserve. Despite these claims about what the commercial banks were doing, there has been a long line of research from 1941, in fact, onwards, showing that that's not significant in the wave of failures that came. The main factor was substantial and unremitting pressure on bank liquidity, which the Federal Reserve did not relieve. I should mention that the Bank of England had nothing to do at this time because there was no financial instability in England and there was no Great Depression. There was a long period following the Second World War when central banks had little to do on either the monetary or financial side. There was no monetary theory of inflation, and insofar as inflation troubled anyone, it was regarded as a sociological phenomenon. Unemployment was the chief focus of macro policy. Inflation was regarded as some cost-push consequence of powerful unions or monopolistic companies. Some attention was given to measures that would take the heat out of the economy, as they tended to describe it. Banks were given directions as to where they could lend, who they should lend to, where not. Sometimes ceilings were imposed on lending. Hire purchase agreements were heavily relied upon. New techniques were devised, special deposits in Britain, Operation Twist in the United States. And controls of all kinds and of these kinds were common across OECD countries. Additionally, in many countries, the banking systems were handicapped by being overburdened with government securities, a legacy of the Second World War. So, for example, in Britain, bank balance sheets had, in normal times, carried private sector credit of about 60% of their balance sheet. That had been reduced in wartime to about 15%, with the balance being taken up with government bonds. And then restrictions prevented them raising new capital. But these were all arrangements that were increasingly seen as not working. Inflation had persisted and was on a rising trend. Controls had not prevented either inflation or the concomitant, never-ending sterling crises in Britain that culminated in devaluation. So the revulsion against inflation finally brought money back on stage. There was, however, still a problem. The problem was that so long as governments ran central banks, they, the banks, could be and were abused for political purposes. Some central banks had greater freedom than others. The Federal Reserve had long claimed to be independent, but it was really only with Volcker in 79 to 82 that it demonstrated it. The Bundesbank and the Swiss National Bank would also have claimed it, and they could certainly demonstrate a better performance than most on inflation. New Zealand was an early pioneer in re-establishing independence. Britain took some steps in that direction with new arrangements in 1992, and then operational independence followed a few years later. And what was remarkable was the long period of low and stable inflation that was achieved around the world in the period from about 1990 onwards. Central banks were held in ever higher esteem. Now that they had been allowed to do what they could do without interference, they had delivered in grand style. Alan Greenspan was widely spoken of as a genius and the mastermind behind the world's stability and prosperity. It was believed that the central banks had cracked it, but they hadn't, which brings us to the recent financial crisis. Without going too far into the origins, it's clear, I hope, from what I've said, that there are strong similarities with previous crises. Central banks presided over a period of rapid monetary expansion, abundant credit, and the growing belief that another new paradigm prevailed. But it all crashed. When the British financial institution Northern Rock ran into difficulties in the summer of 2007, the Bank of England no longer supervised banks either formally or informally, or did any business with banks. So unless someone told them, which the supervisory authority of the FSA did not, they had no way of knowing the peculiar nature and the high risk of Northern Rock's business model. It's a rather strange set of arrangements for an institution that is supposed to be standing ready to act as the lender of last resort, not knowing what its constituency really is. But in addition, as I said at the outset, their eye had come off the financial stability ball. Inflation had been the primary concern for some time, and there had been no financial stability problems for many years. So finally, when Northern Rock collapsed, the Bank of England had to go to its owner and ask for funds. And this had to be done in an ad hoc manner and in great haste. But why it was decided to support Northern Rock rather than follow the 19th century course and let it fail before providing necessary liquidity to the market as a whole seems to be a question worth asking. As the report of the Treasury Select Committee of the House of Commons made clear, there was plenty of scope for things to go wrong and a serious banking run starting at many stages in the process. So why did this unhappy combination of events occur? There are several reasons. We don't have time for all, but among them, and maybe principal, was the old framework had gone. No longer was it clear that good banks would get liquidity and banks with unsatisfactory assets would not get it. Worse, the banks themselves had somehow been led to believe, or certainly believed, that they would be rescued if in difficulty. There are endless examples of this, I think, in British financial life in the 20th century. Additionally, there was an information problem. Central banks need to be sure of getting information on the health of banks. One way would be for central banks once again to engage in daily or more frequent transactions with banks, dealing in commercial paper as well as government paper, so as to get a feeling for how banks were trading and of the quality of their business. That, after all, is a long-standing tradition. When banks first emerged, they invariably required deposits and a relationship before they would make loans. That was the best way of getting to know your customers, and a natural extension of how the goldsmiths behaved as they gradually drifted into banking. Be that as it may, when the crisis struck, thoughts became focused on dealing with it. There was hesitancy, as there had been in some previous crises going back into the 19th century. And furthermore, capital was required. There also appeared to be two lessons for the conduct of monetary policy, neither of them new. The first was to ask the question why, if any series is behaving in a way that is slightly surprising, is it doing so? In the run-up to the crisis, inflation was low, as measured by the Consumer Price Index, despite a sustained economic boom and despite many measures of easy money. Had the question been asked, it might well have been answered that while measured inflation was low, this was the product of a sustained relative price change, the fall, as we all are familiar with, of consumer durables coming in from the emerging developing countries. Such a price change, a relative price change, could not go on forever, and the low consumer price inflation was being produced might well have triggered a reconsideration of their stance. The second lesson, it seems to me, from monetary policy is that it's been another demonstration of the folly of ignoring monetary aggregates. These are certainly not an exact day-to-day or even quarter-to-quarter guide on inflation, but sustained monetary growth is invariably a sign of future inflation. There are many similarities with the Federal Reserve and the ECB in terms of their approach to the crisis. Both played a passive role in the build-up to the crisis. A fundamental problem for the Federal Reserve, according to its historian Alan Meltzer, was the failure of the Fed ever in its history, he says, to set out what its lender of last resort policy was. On some occasions, it would respond in one way, on other occasions in another, sometimes depending on the view of the chairman of the board or of some other group within the board, thus generating uncertainty. And nowhere, says Meltzer, was this more evident in the recent crisis. Finally, you should always say finally in a lecture like this at some stage. It gives the audience hope. So finally, the record of central banks in financial crisis has not been good. It's been checkered at best. They've frequently caused, or at minimum allowed, crises to develop. This, at least historically, might not surprise us. Keynes once remarked that central banks liked crises. He said they benefited from them with increased profits. Well, interestingly, after 1866, that's not true of the Bank of England, because at that point, the Bank of England was obliged to pass the profits from the crisis of 1866 to the Treasury. And then, interestingly, there are no more crises in England after 1866. But in the first great crisis of 1825, just to reiterate briefly, the Bank of England was in big part responsible for the preceding booming conditions that caused the crisis, and then it failed to resolve the crisis by acting too slowly. That pattern continued for several decades through several crises. There is no serious objection to the view that the Federal Reserve was responsible for the financial crises of 1930-32 and concomitant Great Depression. The property bubble and bust of 1988 to 1993 was not well handled, and so on. It should be added that there were occasions when the authorities averted systemic financial failure. The LDC debt problem of 1982 and the stock market collapse of 87 are two examples. But over the whole history of financial crises, central banks cannot be judged to have performed with great credit. They must accept the blame for causing many of the crises and some for the failure of resolution. To some extent, they might be excused because they were being constrained by governments. They have almost always, in crisis, when it came to the crunch, been constrained by politics. We're still far too close to the recent crisis to make a proper assessment. But we can surely ask if it would have helped had central banks taken financial stability more seriously. Some of them did have deep suspicions about the financial system, but they needed to make these more widely known and drawn attention to the fault lines running through the system. That said, lessons were learned from history, and the responses of the leading central banks, while we can be critical of many aspects of them, may well have saved us from another Great Depression. Thank you.
Thank you very much, Forrest. We have plenty of time for questions, so I'm happy to take questions with Forrest and entertain them. If you can keep them brief and pithy, that would be good. But who would like to start?
Thank you. Do you think that your crisis is necessary or possible for central bank to squeeze out the speculative positions in its own currency or other assets?
I'm not sure I quite got that clear. Do I think that crises are necessary? That central banks see crises as necessary in order to squeeze out.
Is it necessary for the central bank to squeeze out all the speculative positions in its currency?
Okay, I think the central bank should concentrate pretty well exclusively on providing monetary price stability and financial stability, and not contemplating what speculators might be doing anywhere. Well, you know, I think it's a myth has developed that there was financial deregulation. If we start with Britain, first of all, I'll outline briefly that the British deregulated from the 1820s through to the 1860s. There was very little regulation, but they nevertheless deregulated. And we then had 100 years approximately, a bit less, of a very lightly regulated system. But regulation began to increase, first of all in the Second World War, then in the 1970s. The British had their first statutory regulation in a Banking Act of 1979. The Bank of England had no supervisory division at all until the 70s. Then it started to grow and it rocketed. We had Basel I soon after for the world system. Basel II followed. When the Financial Services Authority in England was set up in 1997, it had 450 employees. On the outbreak of the crisis in 2006, I think the numbers were 3,500 doing regulation. The volume and the number of pages of regulation across that period, just staggering increase. So in fact, there was a considerable growth in regulation in Britain. In the United States, there are these claims on individual points of there being a deregulatory move, but a very distinguished scholar in the US, Charles Emeritus, has written a paper that really demolishes that notion and points instead to a growing regulatory impact in the US. So it is bandied about quite a lot that the problem in finance was deregulation, but it certainly doesn't hold for Britain. According to Emeritus, it doesn't hold for the US. And I've seen scattered suggestions that these are reflected in other territories. I used to teach a third-year undergraduate course on banking topics, and one of them was regulation. And we knew a private banker, a man who had a small bank in London, and we asked him to come and talk about regulation to our group. And he had the nice trick of arriving with a pile of the regulations that he had to comply with. And his point was, of course, that it was extremely anti-competitive. He had to have the same size compliance department with his 50 employees in total as NatWest or HSBC with their hundreds of thousands of employees. The big banks didn't care too much about that amount of regulation, but certainly it deterred any new entrants. And just you've got me started on something here, clearly. I was speaking to someone fairly senior in Deutsche Bank in London in December, and he, a very good banker, and several colleagues in other institutions had decided about 3 years before that they would set up their own bank. The other people involved were lawyers and bankers, and they embarked on this path to set up their own bank. It defeated them. They could not surmount the regulatory obstacles. So, admittedly, that had increased in the crisis, but regulation has been, of many kinds, has certainly been damaging, I think, across the period.
Is the response from governments and financial authorities in the GFC was in fact to regulate, further regulate the financial try to the financial system to try and stabilise it? Are you suggesting that they should deregulate it even more as a way of the problem?
Well, that's what I had hoped to suggest in this lecture, in part. I didn't spend a lot of time on it, was that in 1825, biggest crisis imaginable, and what was the knee-jerk response at the time? Deregulate. So they relaxed the usury laws, they allowed joint stock banks in limited territory. 1830s crisis, further deregulate. 1847, deregulate again. And so the response at the time was to deregulate, rather than our response has been, certainly in the second half of the 20th century, to regulate. If there's something goes wrong, then we must find it and regulate against it. So yes, I say conceivably different regulation is required, but in all probability, it would probably be less regulation.
Forrest, I got the impression that you were saying that the central banks knew a bit of history, they would have done much better. And secondly, I got the impression that by and large central banks sort of always get it wrong. So when I put these two things together, I wanted to ask you the following question. Do you think monetary policy now has been too loose for too long? Do you think the right thing the central bank to do fairly quickly is to change the sense of monetary policy?
I'm sorry, Bob, I was expecting a much longer run on the thing. No, it's all right. Well, you're taking me really into territory that is too recent. As you know, historians wait a long while before they comment on recent events. But if pressed, then I would say yes. The answer is yes. The supply of liquidity, a big injection of liquidity initially seems to be what was required. The idea that you persist with that somehow seems to me to be wrong. And I'm inclined to feel that had interest rates been allowed to go up, or had the central banks, put their short-term rate up and got the interbank market, at least with some signals to which they could respond, then the financial markets would have picked up more quickly than they did. But that's, a highly speculative position. And I keep coming back to this business of the system had been allowed to change so much that where we once knew what the solution was, the markets knew what the solution would be, they behaved in compliance with that set of understood practices. That had disappeared in the last 30 years. And it did seem to me to be a golden opportunity when the crisis struck to clear the decks and say, we once had financial stability, and here are the essential elements that provided the stability. We should aim to return to these conditions. And these conditions are, in big part, that financial institutions must be able to fail. There must be an entirely credible regime in place that allows them to fail. It must be clear to everybody that they will fail, that the depositors will be protected on a small scale, that shareholders will not be, and we would all take a closer interest in what the banks were doing, how they were behaving, and we would have a better system as a consequence.
You just mentioned then that the depositors will be protected in a small way. And going back to your speech when you were describing the way that Annie Schwartz was talking about a financial crisis that seemed to really echo a bank run. Now there's two strands of literature, one by Diamond and Digby, which implies that there is a strong role for deposit insurance in deterring bank runs, and another strand by Corrector and Wallace, which implies that deposit insurance creates moral hazard. Now, I just wanted to know your perspective on the role of deposit insurance in deterring or potentially deterring a bank run.
Yeah. Friedman and Schwartz, of course, gave quite a lot of credit to deposit insurance introduced in the 1930s, to the 40 years or so of stability in the US financial system that followed. But then Schwartz at least reneged on that and decided that that was not the element that had been behind financial stability. The British never had deposit insurance until 1979. So the empirical support is a bit strange. I'd be inclined to say, yes, deposit insurance is quite a good idea, but it should be provided by the banks themselves. They should get together for the sake of their own reputation, and in this dream world that I have that would bring back financial stability, they would be so concerned with their reputation that they would club together and organize deposit insurance. And it would be for an individual with one bank account covered for a decent sort of sum. So that as salaries, wages are paid in and payments go out, all of that individuals can forget about. The kind of deposit insurance we've got at the moment allows the rich to go around to 20 banks and deposit 100,000 in each, and can turn away with 2 million of their cash completely protected. That doesn't seem to me to be a great idea. So I think, and there is evidence, historical evidence for banks getting together and providing cover. If you think about the free banking in Scotland in the 18th century, that's precisely what the banks did. There was no system, there was no particular grouping, there's no cartel, there's no regulation, there's nobody directing them. But when one of their number went under, the rest of them came together and provided for the depositors. The bank disappeared, the shareholders lost, but the depositors were saved because the other banks felt it was important that depositors continued to believe in the system.
It seems to me that commercial banks haven't learned the lesson from their part of the lesson from this crisis. Do you think that central banks have learned or are learning the lessons that you outlined in the lecture?
I would like to think they are learning, and I think there are bits of evidence that they are, but it does really need the whole system to be reformed. The regulation needs to be cleared away and highly simplified. A satisfactory, credible resolution regime needs to be in place that allows everybody to see that a bank can actually go under, be wound up without too much effect on the rest of the system or the economy. And once these are there, then the central bank can begin to think again about its position as a lender of last resort.
Time for one more question.
Am I right? I'm thinking that that is what happened in Sweden in the 90s. The government took over the banks, providing for the depositors, and then putting the house in order and then selling it back again.
Yes, I did once know the Swedish story, but I think I've forgotten it. But they sort of separated the banks into what they called good banks and bad banks, I think. And there was a lot of talk that we should do something similar. And so you let the good element get on with their business and gradually wind up the bad elements. But that was a particular solution to a particular crisis, I think. Maybe we should have done some of that just to resolve this particular debacle. But in terms of what lies ahead, I would hope that all these other bigger agreements could be reached. The US claims it is on the way to making it clear that banks will fail and be wound up. Our former Deputy Governor, Paul Tucker, claimed that there are moves afoot in England that will take us there in some short time period. We'll have to see.
Okay, thank you very much, Forrest. Let me wrap up things very quickly, just with three quick thank yous. First of all, to Selwyn Cornish for his illuminating remarks about the nature of the lecture, Celestine Melville and, of course, Professor Capie. Second, this is a public lecture. It relies very heavily on the public, so thank you very much for coming on to these things. I hope you will continue to support these kind of lectures as we go on. And then finally, of course, to Professor Capie. I'm not sure if the nature of what economic historians do, looking back over past blunders, and I often approach economic historian lectures with some sense of trepidation that we're going to hear a terrible story of gloom and so on. It's very refreshing, I must say, that at least we can imagine a world of financial stability where, of course, reaching that imagined world might be a different story, but at least we can imagine something in which central banks, it appears, in fact, there are potentially no limits to central banking, and we can achieve some hope of financial stability. So please join me finally in thanking Professor Capie for a very stimulating talk.